Hey folks, it's Simon here with your Tao Daily for Tuesday the 11th of March 2025. Another eventful session on Wall Street on Monday. The S&P suffering a 2.7% loss. That's the biggest loss it's had in several months. And if you have a look at the chart here, you can see we've taken out what could be a fairly critical support level. I was expecting this support level was a good probability to hold. We've obviously got a close below that. If we get another close below that level, then we'd have to be looking at 540 as the next downside target. 540 would be a logical target because it's coincident with historical support and also a 61.8% fib retracement level from this major low. The S&P has also joined the Nasdaq in taking out its 200-day moving average, the purple line here, and the decline that we've seen from the top is the biggest decline we've seen since the August washout during the Yen-Mageddon episode. So if I run a Fibonacci projection from the all-time high, you can see that this decline to the low was actually bigger than the decline we had last August. So another close below this level, and I think 540 becomes the target. Doesn't mean we get there in a straight line. We are quote-unquote oversold. I've shown you this chart before, but when we get to this green line, 3 ATRs below the mean, generally we're due for a bounce. So we're due for a bounce any day, but ultimately I think a bounce is all we'll get, and it looks likely to me that this low ultimately will be taken out. If we look at the S&P futures, they are making new lows in the overnight session. Coming across to the Nasdaq has clearly taken out a key support level here. And what this does is it fulfills the requirements for a double top. All right, so if you take the difference between the neckline and the all-time high, we're targeting levels of around 460. But I would not rule out a trip back to this 448 kind of level because you can see this is a level price has respected in the past as well. Most of the weakness was concentrated again in Mag 7 names. You can see a lot of red in big cap tech, semiconductors, financials, real estate, utilities, consumer defensives were generally okay. Healthcare was okay. It ended up being a 77% down day, which is actually not that bad in terms of breadth, given how big the index fall was. And in fact, if we look at RSP, which is the equally weighted S&P 500, that was only down 1.4%. And is actually still trading above its January low, all right, which is different from most of the other indices right now. Market structure continues to indicate that we're closer to a bottom than we are to a top, but I think any rally from here is likely to be a relief rally with a resumption to the downside rather than seeing us rocket to new all-time highs. I've been playing this market with a mixture of long and short positions. I've got long put positions, so effectively short positions in Lyft, which was down 7.5% yesterday, and Snap, which was down 6.5%, so clearly underperforming the Nasdaq. I've also got long positions in Take-Two, which is underwater. I'll be coming out of that one, and Meta, where I've got a put credit spread. I'll be looking to probably roll that to a lower strike. So I'm going to keep the shorts on while they're still working, but no plans to add to them with markets looking as washed out as they are. That's what I got for you today, folks. I hope it helps, and I'll catch you next time. Thank you.